Hey, I'm going to go through a high-level overview of a couple terms that keep getting thrown around the last couple days. I know the headlines have us going back to 2008 with WAMU, Wachovia, and others, but here's a quick refresher on FDIC insurance versus SIPC insurance. Let's start with Federal Deposit Insurance Corporation. It's an independent federal agency that protects deposit accounts at banks and other financial institutions. The FDIC was formed in 1933 and offers coverage to more than 5,000 institutions. The FDIC insures certain types of deposit accounts held at FDIC-insured banks, including checking, savings accounts, money market deposit accounts, certificate deposits, or CD accounts. Say your bank unexpectedly goes under and shuts down temporarily. If the bank is FDIC insured, the money in your account doesn't simply disappear. Instead, the FDIC can do one of two things. First, it can arrange the sale of a failed bank to another bank. So if you're used to be banking with ABC Bank, the FDIC could arrange for it to be purchased by XYZ Bank. You'd then become a customer of XYZ Bank without losing access to your money along the way. Now, if there's no ready buyer for a failed bank, the FDIC can pay out funds to depositors directly. That involves sending out checks to people who had accounts at the bank. It can take a few days to receive payments in this scenario, but again, your money doesn't just disappear because the FDIC protects it. The basic FDIC insurance limit is currently $250,000 per account holder per insured bank for deposit accounts and $250,000 for certain retirement accounts deposited at an insured bank. These insurance limits include both principal and accrued interest. Now, if your bank also offers investments, they are done through a separate entity of their business. The FDIC does not insure money invested in stocks, bonds, mutual funds, life insurance policies, annuities, municipal securities, or money market funds, even if these investments were bought from an insured bank. That's where SIPC, the Security and Investor Protection Corporation, comes into play. It is a non-profit membership corporation that was created by a federal statute in 1970. Unlike the FDIC, SIPC does not provide blanket coverage. Instead, SIPC protects customers of SIPC member broker-dealers if the firm fails financially. Coverage is up to $500,000 per customer for all accounts at the same institution, including a maximum of $250,000 for cash. SIPC does not protect investors if the value of their investments falls. When you think about it, it makes sense. After all, market losses are a normal part of the risk of investing. Understand the difference between the SIPC versus FDIC is important if a worst case scenario happens and your brokerage or bank fails. Not all banks and brokerages maintain FDIC or SIPC coverage. So if you have money at an institution that isn't covered, you could have a difficult time trying to recover any of your savings or investments. The easiest way to know if you have either type of this coverage is to ask. Banks typically advertise their FDIC insured status online and at branch locations, so it's relatively easy to verify. With brokerages, you may have to dig a little bit deeper into the fine print to learn if the company is SIPC insured. If you can't find the answer on your own, contacting that brokerage is the next step. Now, I know this can be a little confusing, and I could have gone a lot deeper into some of the nuances of each. If you have any questions or concerns, do not hesitate to reach out.